So let's talk about the markets in the last 7 days or so. A lot of action has transpired. There's been a lot of volatility, and I actually don't anticipate that getting any better, but that's in our favor. Part of this video is to let you know how in tune we are with the markets and to give you some topical advice here. Last Thursday is really when most of the volatility began, and if you'll pay attention, that's when our accounts started to go up in figures. On Thursday, they released the new non-farms payroll jobs numbers, which showed, I don't have this written down, but roughly 114,000 jobs were created versus the roughly 200,000 they were looking for. All of what happened last week goes back to the employment picture, and the employment picture is what it's all about. None of this is about inflation anymore. That's kind of a sideshow where they're trying to get us to look over there and not look over here. All the charts that we've been sending you for months indicate that unemployment is picking up. We got that confirmation on Friday, and I'm recording this on Wednesday before the Friday you get it. And unemployment has ticked up from 3.8 to 3.9 to 4.1. Last Friday, it was 4.3. This triggers what they call the SAHM rule, S-A-H-M. SAHM, very simply, is accurate at predicting recessions. Has predicted every prior recession before in the last 100 years. So again, our thesis remains. Markets are extremely overpriced for the environment that we're in. Unemployment is rising. The folks on initial unemployment claims, which comes out every Thursday, continues to go up. We'll be seeing a new number tomorrow. I would expect it to go up as well. Really, there's just not a lot of positive things. Now, what happened on Monday, the markets were set to gap down by 6%, and we were sitting up 3%, our accounts, because we run short. And what happened, the plunge protection team came in and, of course, rescued the day with our tax dollars again. The reason behind that plunge was, I believe it's Ueda, is the Japanese finance minister over there, indicated that Japan is going to start raising their interest rates, which makes the value of their currency higher, which really just messes up a lot of stuff. We've got some content down below in our email today where Justin has put together a good written version of that. I think it's really hard to explain verbally, but that's another threat we have to us, is Japan actually devaluing our currency or the dollar to the yen. Just last night, SMCI reports, one of the semiconductor chip manufacturers, nowhere near meeting the expectations. They're down 20% today. Airbnb reported earnings last night. Their forecast is bleak, to say the best, down over 20% today as well. Wendy's, McDonald's, you've got Red Lobster going out of business. You know, it just goes on and on and on. So the story is not a positive one. The only reason it's a positive one is because there's an election coming, and the incumbents happen to be controlling the media to try to tell us the story is good. We will continue to protect your dollars just like I protected mine, because I invest my money the same exact way as you. One of the old sayings goes that you should be eating your own cooking, and I absolutely do. I don't do anything different than you, because I learned a long time ago that actually can present a conflict of interest. So I invest the same way. We've got unemployment numbers coming out tomorrow, or just the initial unemployment claims. Really, the biggest meeting that's coming up is going to be the Consumer Price Index next Friday. If that comes in hot, so showing inflation is still going up, which again, it's not about inflation, but if it comes in hot, then the Fed is really stuck. They have no choice. They can't cut rates because inflation is still high, and we are heading to a recession. Unemployment is going up. If rates stay up, unemployment going up, things will get bad, and that will be okay for us. So don't worry, markets go down, we go up. We appreciate you all. I hope that you're doing well, and feel free to call or email if you have any questions at all. So on the first chart here today, we're going to look at the SPY, which is the S&P 500, and we'll just take a glance and see kind of where we're at. What you notice in this chart, our first point of interest is the two lines at the top. The maroon brown looking line is what they call the 20-day moving average. So they just take the last 20 days price and average that out, put it on a line. So that's said to be a really short-term moving average. The purple line is a 50-day moving average. So if the 20 goes over the 50, which you're seeing here, that is a bearish sign. That means near-term price movement is negative compared to medium term, which is the 50-day. Now that we have broken the 20 through the 50 on the SPY, we would expect to see us gravitate somewhere down towards the purple dotted line here, which is the 200-day price moving average at about 500. Once we get there, we'll give you an update. So on the second iteration of the SPY chart, the S&P 500, I want to show you what we do as technicians to determine what are key levels that we may consider, being against the market or for the market. So in the next iteration of the SPY chart, we've drawn in a key point of interest line, this yellow line. And each red bar or red candle on here represents a down day in the S&P 500. Each green represents an up day in the S&P 500. The yellow line is what we would call a kind of a pivot point type of line. You'll notice there's a big congestion area back here where you had green bars that would bounce its head off of the yellow line, and then some red that kind of came down through it. Short of it is, this yellow line is a point of interest. Today on August 7th, the green candle to the far right is hitting that point of interest and not making it through. So our indication again is until we get over that yellow line, our expectation is to head down to the 200-day moving average, which is your purple dotted line below. So in our next chart, we're going to look at SOXX. If you recall, this is of big interest to us, the world. It's the AI stocks. It's NVIDIA and Broadcom and Qualcomm, all of the good fun stocks. If you recall, in a past video, we talked about how expensive and overbought it was, and we were short that, and we've done good with that. But we're at a key point. We need to know if we're going to continue to short them or not. So let's take a look at the charts. In this first chart, we're also looking at a key moving average. You can see that today, the red candle to the right is sitting right on the 200-day moving average. Anytime an index, which is a group of stocks, so like SOXX, anytime the price goes through the 200-day to the downside, that's very bearish. That means that you should absolutely short that stock, and you should expect it to continue to go down in balance. We're sitting right there. It went way through, and they, being the market makers, have tried to pump this back up a couple of times. It's sitting right on the 200-day. SMCI reporting earnings last night and not doing well at all is probably going to put the nail in the coffin of the semiconductor AI story. But we will find out, and we ultimately have NVIDIA earnings coming up here the end of the month. So always something fun to talk about with AI. Okay, so let's look at the second version of our SOXX semiconductor chart. In this chart, we also have a key level or key points of interest, which just happens to be right now, right at the 200-day moving average. So we're watching this like a hawk. No kidding. It's the last thing I look at before I start reading at night, and it's the very first thing I look at when I wake up at 5 in the morning. So we're very interested. You look at the yellow line, it's a point of interest. You'll see to the left there's a grouping where some of the tails, they call it, just the line of the candle hit that yellow line. Then in the middle, I've labeled resistance support area there, and we're back here touching that again, and it looks to be failing again today on August 7th. If the semiconductors fail here and go back below the 200-day moving average, we are in business, folks. We will continue to short them, and imagine there's a lot of money to be made there. In our next chart, we're going to look at the NASDAQ QQQ index. This holds your common technology stocks like Apple, Microsoft, NVIDIA is in there as well, Google, the big names that we're all familiar with, and this is a judge of how well the technology sector is doing. In the first chart, we're going to look again. You'll see where the brown line has went through the purple line. So this is your 20-day moving average going through your 50-day moving average. This is the first step to being bearish. That happened a little while back, and you can see that we've continued down, and actually there was a green candle that went through the purple line below, which is the 200-day moving average. If we get below the 200-day moving average on QQQ and stay there for a couple of days, the bottom is going to fall out of everything. So it was important to them on Monday when this gapped below the markets were opening below these 200-day moving averages, that the Fed stepped in and pumped in a bunch of liquidity to hold it up, and they're still doing the same thing, just waiting on some type of reason for this to be let go, but we'll see what that is. Also, we'll look at the key resistance levels for QQQ. I've drawn a line here, and you'll see really clear in this chart. There's a grouping to the left-hand side here where the candles tend to kind of, quote, hit their head on the yellow line. Once we make it through in the middle section of the chart, you'll notice that it tends to gravitate back down to that until it took off to the upside. And there's one red candle here on the right side that stopped right on the line, and then we gapped down below, and we're now testing that yellow line again. August 7th is this candle to the right hand side. As I'm recording this, which is noon on Wednesday, August 7th, we are failing at that yellow line again. So if we don't get above yellow, we would expect this to go back down and touch the 200-day moving average, which again is for the markets to be going down. So our last chart for today is KRE, which is the Regional Banking Index. You've heard me talk about bank failures for over a year now, with the SVB bank failure in March. There really has just been a lot of trickery played with this index. They know that we're watching it. They, being the feds again, know that we're watching the regional banks and that would be a sign of economic failure, so they are holding them up. They all reported earnings just recently. Not many of them were good, but surprisingly all the stocks stayed up. They're doing some games where they're taking unrealized gains, which is bad loans. The feds have allowed them to take that off of their balance sheet so they don't have to report those, therefore making their earnings look acceptable. It's just a matter of time. If the Fed cuts rates, it'll help the regional banks, but it will absolutely kill the rest of the economy. If they don't cut rates, it will kill the regional banks, which then will kill the rest of the economy. So it's a really tricky spot to be in, and I sure do not envy Jerome Powell. So let's take a look at this chart. I didn't break out levels or anything like that. I left on the right-hand side here, you'll see these colored boxes. These are what they call Fibonacci levels. Fibonacci was a master mathematician back in the day, and if you want to go down that rabbit hole, you can look it up. But Fibonacci is important levels that these prices tend to stop at. We're sitting on somewhat of a key level down here now. But our statement here, again, the 20-day goes through the 50-day up above, and you get down to the 200 and everything gets held up. Every sector is being held up. We are short the regional banks. We have about 6% of our accounts shorting the regional banks. So if they go down, we make money. We've done okay. We are actually positive on that position because you can see regional banks have come down in value, but we do need to get through this 200-day moving average, which is roughly $51 down there. If something happens, like interest rates are going back up now, that could be a challenge. If we get some type of failure, maybe New York Community Bank Corp, which is the #1 target, could be that. But this is a key chart for us to watch, and you may want to watch it yourself. Thank you for listening today, and we'll continue to do more charting updates. The charts have been very volatile. We don't want to put these out in front of you all the time, but I'm thinking maybe once a month. I appreciate your patience with all the volatility that's happening in the markets. We do a lot of trades, which creates a lot of trade notifications to you. We'll stay in touch. We are on top of it. You really should have nothing to worry about. Have a great day.